I call the meeting to order. Good evening and welcome to the December 17th, 2025 special study session of your Ashland City Council. This evening we have one agenda item, the electric rate presentation and proposal. Sabrina?
Good evening, Mayor and Council. Tonight, Director Tom McBartlett is here, as well as our consultants, to walk us through the utility study for cost of service and the rates. And so with that, I'll turn it over for him to introduce the team.
Good evening, Mayor and Council. Thanks for your time tonight. We're joined tonight by Mark Beauchamp and Mike Johnson from Utility Financial Solutions, and they're going to walk us through the process of a cost of service study, the financial projections, and then the rate design that comes out of that, and how all those pieces fit when they applied them to the City of Ashland and what their recommendations are for maintaining fiscal health in the utility. With that, I'll let Mark and Mike give their bios and introductions.
All right. Well, thank you very much. I really appreciate the opportunity to present to you the results of the cost of service study tonight. I want to start by telling you, I have Mike Johnson with me, and any specific detailed questions, Mike is the one who's going to know more about it than myself. I want to start by telling you a little about Utility Financial Solutions. We've been doing utility cost of service financial projections since 2001 for about 25 years. We teach the cost of service courses and the financial planning courses for the American Public Power Association, American Water Works Association, and also the American Gas Association. We do the work for approximately 18% of all the public power systems in the United States. And we've done work in 44 states, including several islands, such as Guam, Barbados, Bermuda, and in the Caribbean. And what I'm looking for tonight, I want to go through the results of the study and also to discuss from a financial perspective how we look at the financials to assess the financial stability of a utility. All right. I mean, financially, you guys are in a great position from the standpoint you have very low debt. Your cash reserves are good, slightly above what we'd recommend as a minimum. However, your system is aging. It's in the neighborhood of high 50% depreciated, which is on the high side. And as a result, there's a capital improvement program to try to lift you slowly over time out of that situation, put you more into normal ranges, which is around 50%. Also, in looking at the details of your financials, you're in a situation of your cash burn. You're burning about $1.5 to $2 million a year in cash in the electric utility. And what we're trying to do is to develop a plan that accomplishes two things. One is to keep the utility financially stable, and the other one is to minimize the rate impacts as much as possible on customers. And that's kind of what we're here today, is to go through that and get that process and get your input on our recommendations. So as I go through this, please feel free to stop and ask any questions you have along the way. And there were some great questions sent to us via email, and I hope to address those as I go through the study tonight. So I'm going to go ahead and share my screen.
So, Mr. Beauchamp, we have a counselor who is also on Zoom or on
Yes.
Teams here. And so, Counselor Hanson, when you want to ask a question, please raise your electronic hand. That will help me see it from here.
Thank you, Mayor.
Okay, great.
All right. And remember, the purpose of today is to get input and feedback on what we're proposing. So the first thing I just want to go through briefly is what the process is in a rate study. And A rate study consists of three components. It consists of a long-term financial projection. Our models go out like 30 years, but we typically only show the first 5. And once we're done with the financial projection, we then do the financial modeling identifies how rates should change in total over time. In other words, what the ideal revenue requirements are for the utility and how to adjust rates slowly over time to get us there and to balance the financial stability with the rate impacts on customers. That's the first step. The second step is the cost of service study. And what a cost of service study does is it identifies how much it costs to provide service to each class of customers. And ideally, what each of the rates should be. In other words, what the energy rate should be for residential, what the customer charge should be. If you're a demand metered account, what that demand charge would be. Now, the last step, which is the rate design. And we do have a preliminary rate design, but that's not, it's more to get our models working. The purpose of tonight is we typically, as part of our normal process, after the cost of service study is complete, we go to the governing bodies of the utility to get their input on the rate design process itself. With respect to how it's impacting different classes, different types of customers, what the objectives are of the governing body with respect to electricity, if you want to promote energy conservation, what the different objectives are. And I want to just state this. You have probably one of the lowest electric rates in the United States. You know, the Northwest in general is very inexpensive. Your average residential customer right now pays around $70 a month in electricity. And if you went and took a national average, it would probably be upwards of about $120 a month for the usage, the average usage of one of your residential customers. So it's something to be very proud of. And that's driven because of two things. One, BPA has primarily hydropower, so your cost of electricity to purchase it is on the lower side. But beyond that, it's also on your distribution system. You operate it very efficiently, and we can tell that when we look at, because we break out all the components of the study, and we can identify how much it costs to provide distribution services. And you're definitely on the lower side of most utilities, most public power systems around the United States. You have a lot to be proud of with utility. I'm just really trying to make sure that you stay that way and keep your customers happy. So when we go through the study, the objectives, what we look at is the very first thing is that financial projection. I'll go through all of these financial targets we look at. There's three main ones that we use to assess the financial health of a utility. The first one is debt coverage ratio, which even though I'm going to cover that, you don't have any debt. You're a debt-free utility, so you're very fortunate. Then we look at what the minimum level of cash reserves the utility should maintain. And I say minimum because cash reserves are going to go up and down over time as part of it's almost like a natural cycle. It's dependent on the age of the infrastructure, how much you're spending in capital. And so a target cash balance is something that we really cannot identify what the target should be. What we can identify with confidence is what the minimum level of cash should be. And I'll go through our calculations and how we determine that. We also establish what we call an upper boundary, which is a target operating income or optimal operating income. And I'll get into what we're trying to accomplish with that. but that becomes our upper boundary. In other words, we don't want to exceed that optimal operating income target, because if we do, we're overcharging the current ratepayers. So what we do is we identify the minimum level of cash, in other words, the minimum level of the rate adjustment, and we identify the maximum amount that we can't exceed. So we have a range that we try to keep within. And identifying revenue requirements is not an exact science, and that's the reason why we identify this range, to try to keep the utility in, to make sure we're not overcharging customers, but we're also keeping the utility financially stable. And you'll see that when we get into the financial modeling. As part of that financial modeling, we develop a rate adjustment plan, which is a rate track. Our models, we're looking out 5 years, and what our anticipated rate adjustments would be for each year. And then we're also going to go over the cost of service results. Even though that's the heaviest lift in a rate study, we only have like 2 slides related to the cost of service results themselves, which look at how each class is performing. In other words, are we recovering costs appropriately from residential or from your commercial class or from street lighting? The cost of service study gives us that information, and also what that fixed monthly customer charge should be. We also, as part of this presentation, I want to go through, we did develop a sample residential rate design so you can see what the typical impact would be on what we're proposing. I will tell you right up front that what we're looking at right now, it's about a $3 a month increase in the average residential customer's monthly bill. So it's kind of what we're looking at right now. So before I get going into the actual presentation, is there any questions for me at this point?
No, not yet. Thank you.
All right. When you look out into the future, we take your historical financial statements and we project them forward. We don't use utilities budgets. We do use their capital improvement plan, but we don't use their operational budgets. And the reason we do that is budgeting is it's done for a different purpose. It's done for what we call a regulatory purpose. In other words, the budget is brought to the city council, and it kind of puts a cap, in a sense, on what the utility can spend. What we do is different. We do a long-term projection based on how you performed historically and how we anticipate you're going to perform in the future. So we don't look at budgets or don't use the budgets directly. We do review them in case there's any significant changes. But when we look forwards, what we have on this screen is what we call significant assumptions that we made in our study. One is the inflation rate. We assumed an inflation rate of 3.1%. It's about the norm right now. It's running right in that neighborhood. A modest growth rate of 0.2%. Then the changes in your purchase power cost, you can see it minus 1.6, 0, minus 0.3, and then 1 and 3. And then the transmission cost change, which is 17.6%. And then you have investment income, that's a small one. But what that represents is how much in your cash reserves that you have available, how much interest income you're going to get on that. And then the utility funded capital, which is about $1 million a year. So I put this in, go ahead.
Mr. Beauchamp, can you go back one slide? Can you talk a little bit more about the numbers under the transmission change column and help us understand what is driving those different numbers?
Mike, I'm going to have to lean to you on that one.
I can take this one. So we're in our current rate period for Bonneville, the last of the existing contract. They did a 3-year rate period instead of a 2-year. It's because they didn't want to do a 2 and a 1 because of the process to get there. So in those projections and what actually went into effect October 1st of this year, which is the federal fiscal 26, is a 17.6% transmission rate increase, but that's for the 3 years. So it goes into effect all at once, but there's no more rate increases during that 3-year rate period.
So that's why the two following it are 0, 0.
Correct.
And then it starts to pick up again. Okay.
Right, and those are just real guesses after those 3 years. I mean, we'll have, once we get, closer into 28, that's when the forecasting will start coming. We'll have better ideas and be able to forecast if we need to adjust more.
Thank you. Councillor Sherrill?
Yeah, thank you. Tom, maybe you can tackle this one on the same slide sheet here. Assuming that some of that reserve capital that we have in these later slides is invested in some kind of fixed rate, super safe fund, can you explain how we're only getting 1/3 to 1/6 of the return of the approximate inflation on the preceding line? Like if inflation we're figuring is at 3.1%, what kind of investment would we be putting our cash reserves in that are making 1/3 or 1/6 of that at 1% or 0.5%?
Actually, the 3% to me is a high number compared to most. Because of the way accounting rules are, if you invest in something, like say you invest in a 5-year note and a 5% interest income, and interest rates go up, and so the value of your investment goes down, that gets recorded on your accounting statements, which a lot of times utilities don't like to do that because it makes, it shows losses even though they're not real losses. That's one. Two, because they're dealing with public funds, usually the investments are more secure and stable to prevent any potential losses. And most utilities are in the 1% to 3% range, so those numbers are not alarming me at all.
Okay, yeah, if we have inflation at 3% and our investment income at 1%, that's a 2% net loss. That would not be an investment.
Yeah, if you go back, right now, you can get a little bit more on your passbook savings. I know you're more than that, but if you go back even 2 years ago, you're lucky to get 1%. So, but that, I'll be honest with you, that is a very, very modest adjustment. Whether that was 0 or 10%, it would not change any of our recommendations.
Copy. Thank you, Mike.
Yeah.
Councillor Hanson?
Thank you, Mayor. Earlier, Mark, you started off by saying that a lot of our infrastructure is old and that we're burning about $1 million of cash annually. So when we look at this slide, that's our furthest column in the right, correct?
A lot of it is. You're suffering about a $500,000 loss just in operations. And then on top of that, you have the capital improvement program, which is about $1 million. I think last year, your operating loss was, on a cash flow basis, was about $425,000. And then on top of that, you have your capital.
Councillor Dale?
Thank you, Mayor. I guess I'm trying to understand, and maybe Bryn, you could help with this too. I'm trying to understand, Mark, where you're talking about the $1.5 million to $2 million a year loss year over year actuals with cash. As I look through our actuals for the past 5 years, we've been net positive from 1.6 to 2.2, and in the most recent year, the actuals of 2025 has a negative 1.8 because of the large write-off that we had, is my understanding, was from the utility bills. But as I go back, 2021, 897, actual 22, 1.6, 2023, 2.1, 2024, 2.2 actuals operating. Am I missing it because we're not calculating in, capital depreciation and other things? What am I missing from a cash flow standpoint here?
Well, right now, I think, I don't know exactly what you're looking at, but I'm assuming it's your financial statements and you have net income.
I'm looking at
So
my
you
annual
start-
financial reports for each year.
Yeah, correct. So you're looking at the net income, I'm assuming?
Yep.
And that net income includes depreciation expense. If you, it's about 400,000 a year.
Okay.
That's a non-cash item, so you have to add that back to get cash. But then what it doesn't include is your capital improvement program, which would be a reduction.
Is that right when I'm looking at actual capital outlay in there? How would, maybe Tom, you could speak to that as why when I'm looking at capital outlay, is that different from our capital improvement program?
What you're looking at in your financial is that year's capital outlay.
I agree.
Yeah.
Maybe am I not stating correctly? So I guess what I'm saying is if we have a capital program and you're going to invest X amount of capital year over year, correct? Would that not be
Correct.
reflected in our financial reports
It would be reflected
as an
in the
expense?
capital.
So there is a line
Financial
item of
reports.
capital outlay in 1.1, 1.4. So, okay, so if it's reflected here, but you're saying it's not reflected somewhere else, or where am I missing? And it's certainly open to understanding a little bit better. Like, as I look at our financials, I'm seeing capital outlay, which I assume is an expense, it is a capital expense that we've budgeted for, of course. So.
And you said that was 1.4 million? in the year you're
1.4 million
looking?
in fiscal 2024,
Okay, and what was the net income in that year?
2.26,
Million?
yes.
That year, you must have, because your depreciation expense about 400,000, so that'd be about 3 million in positive cash flow minus the 1.4. So that year, you did add 1.5 million.
And the year before that, it was 2.14 net income with a capital outlay of 1.15, 1.2.
And that year, it would be about $1 million positive. I'm assuming a lot of that has to do with the fact that your transmission costs are going up.
I'm fine with that, except for the fact that I'm just wondering why, when the previous statement that was said, I'm sorry, Mary, I don't.
Go ahead.
Okay, thank you. When you said we're continue to burn through 1.2 to 2 million year over year, I'm not understanding that statement.
Oh, that's
And I
in
may
the
be wrong,
projection.
of course, but
No, maybe I misspoke. It's in the projection. And I'll show you that when we get to that slide.
okay, thank you.
Okay?
Counselor, we have one more question. Counselor Kaplan?
Yeah, so thanks. And I think this may be for Tom as well. The projections for the energy demand change, I understand that's the cost of the actual power going down this year and then flat. And then does that also have something to do with the BPA? rates?
That came from the same forecast
Same
projections
forecast.
from BPA
So that-
for the 3-year rate period.
Okay, and then the other, thank you, that's what I expected. Now, just to put these things into context, because the transmission charge and the energy demand charge are not exactly the same, what is the transmission charge as a ratio of the transmission to the actual power?
I don't know if I can put it into ratio.
Oh, that's okay.
Our,
Just
our energy costs are.
cents per kilowatt hour.
Our energy costs are around $7.5 million a year, and transmissions are around 1.2 million a year.
Yep.
So,
So about 20%, less than 20%.
yeah.
Okay, thanks.
Okay. Go ahead.
So I just wanted to put this slide in on debt coverage, even though you're a debt-free utility. You know, if you ever do incur debt, if the utility ever incurs debt, usually there's a bond coverage requirements that come with it. And that becomes critical, absolutely critical, when we do modeling, because if you fall below the coverage ratios that are specified in the bond ordinance, you're in technical default on the debt. So I just want to have this slide in there just so you understand what debt coverage is. Right now, it's not anything that's driving anything at your utility.
We have a question. Counselor Dale?
Thank you. Thank you, Mark, for bringing this up. Could you just, for example purposes, what would be a standard debt coverage ratio? or
The
reasonable?
standard for an electric, yeah, the standard requirement in a bond ordinance is normally 1.2 to 1.25. However, obviously, we don't want to fall below that. So because electric sales are dependent on weather, and then there's also unexpected things that can occur that could increase your expenses in a year, we typically target a minimum coverage in our modeling of about 1.4 to 1.45 to make
Perfect,
sure
thank
we
you.
don't go in default. So,
Excellent, I appreciate that, thank you.
Go ahead.
okay. This is our financial modeling without any rate adjustments. And if you look at this, let's see, make a pointer. The first one we look at is debt coverage, and of course that it's not applicable. The second major one is cash reserves. And you currently have adequate cash, about 5.6 million. Our recommended minimum is about 4.5. Cash balances are decreasing each year. And in 2029, we're projected to actually go negative in our cash in the projection. And obviously, cash is the biggest thing that we look at. The second thing that we look at is our cap, or what we do not want to exceed when it comes to setting rates. And that's this optimal operating income. Where's my cursor? There it is. This optimal operating income, which is about $1 million a year. Based on the projection, the operating income, we're looking at operating losses of about 1.1. Operating income is different than net income, so I just want to let you know that. But operating income is $1.1 million loss, and those losses are projected to grow each year based on the modeling that we've done. Is there any questions about this slide?
Yes, we have some questions. Councillor Bloom.
Yeah, thank you, Mark. Appreciate you putting this together for us. This question's actually probably more for the city manager, for Sabrina. So hypothetically, we don't do anything. We're seeing here at 29, we start to go negative. What happens operationally? What do we do? How do we, or what would a future council have to do to rectify that if no action was taken?
So the longer you operate in the red, the more ground you have to make up with rates later on. So, you see this everywhere when, bodies hold rates steady and don't do, small incremental increases. You see large impacts to make up the need to kind of rebalance the books for the enterprise. And operationally, it constrains us in terms of we can't respond to emergencies if we need to. We can't do the work that we need to keep the system functioning. And then eventually you're looking at removing personnel, which also impacts our ability to operate day to day.
So to kind of, thank you, to summarize that, essentially, if no action is taken, this is the financial situation we're looking at in 2029. The reality is that a future council will have to decide on significant rate increases to bring that back, or potentially even have to have a conversation about selling off a public utility, in which case, then nobody really gets to have a say in the rates, correct?
Right. I think, and Tom and Bryn may know this history better, but I think the reason Ashland has retained an independent electric utility is because it has allowed us to keep rates lower than the surrounding area, much to what the consultant spoke to earlier with BPA and hydropower. But this, kind of municipally owned utility is fairly rare in the grand scheme of things, and that has allowed us more control. But on the flip side, it requires, decisions to ensure that we can maintain that long term.
Thank you for that exercise in reality.
Can I add one thing to that on your first question, Counselor? Operating in those red areas in the years going forward will reduce our ability to debt finance things like substation expansions that we know we need to do. So.
Thank you. Councillor Kaplan.
Yeah, thanks, Mayor. A couple of questions along the same lines. First, in order to understand the numbers on the sheet, the projected cash balance for 2026, the only number that's in green, $5.6 million. I'm assuming that is at the end of the fiscal year based on an assumption that the operating income is negative. Is that correct?
That's correct.
Okay. And then, along the lines of some of the previous questions, we've seen our cash balances have, they've been high. In fact, even right now, they're $1.1 million above that projected cash balance or so. But they've been coming down last little bit, and I wonder if that might if not, because we have not raised rates for the last 5 years, has that constrained our ability to invest in capital to the extent necessary so we don't have the aged system that you're talking about?
That's a great question. And my gut feeling is you brought us in at the right time. Because if you had waited even a year longer, and I did run some sensitivities on this, I'm going to jump ahead for a moment, but we're looking at a rate track of 3.9% annually each year to keep those cash reserves above the minimum. If by chance the city council said no increase in 26, that would mean to keep our cash above those minimums, we need 5.5% increases over the next 4 years. So in a sense, instead of having 19% increase or so, you'd end up with a 24%. So, and the longer that you delayed, if you didn't do the 27, then you're probably looking at double-digit rate increases. And, those, from a customer's perspective, in our experience, if you have increases less than 5% a year, it tends to be very acceptable. I always use a joke and say the only ones that give you a hard time is the governing body and the two people that show up at every council meeting to complain about everything. But from a ratepayer's perspective, they understand that your costs go up. And it's keeping those adjustments within a modest range. Increases between 5 and 10%, they tend to be acceptable to a degree for residential ratepayers, but it can cause issues on large users. But we always want to try to avoid, especially with electric, are double-digit rate increases, because those can be substantial, because electric bills are a lot higher than water and wastewater. So that's what we always try to avoid, are those double-digit rate increases. There's one other thing I want to mention. We've talked a lot about the financials, and your system being 59% aged, it's not excessive, but you're starting to get to that point where, and your capital improvement program is showing it, trying to bring that age down, because the most important thing to ratepayers is the reliability of the service, even more so than the pricing. I live in Michigan, and we're served by a public power system. And literally across the street from us, they're served by an investor-owned utility. Back in May, we had a major storm come through. Our lights blinked. We maybe a 5-minute outage. Consumers Energy, the ratepayers across the street, were out for 3 days. And you see that happening all over the country when it comes to public power systems and their reliability over investor-owned utilities, because of their ability to reinvest and respond to outages, which is, I know you initially talked about, looking at, nearby investor-owned utilities and what would happen if you sold, your rates would go up. It would. But the other part of it is your reliability would go down. And that's even more important. So.
Counselor Kaplan?
Yeah, thanks,
Follow-up?
Mayor. Just a follow-up on this because I want to understand what would happen, the hypothetical that we didn't increase rates. You've all talked about the impact that would have on reliability, on be able to respond to emergencies, et cetera. But another way that we would likely respond to that is just not invest in capital. So we would have, further deferred maintenance or deferred capital investment that wouldn't maybe show up immediately, but would actually show up, further on down the road. Is that a fair assessment?
That is exactly right, yep.
Counselor Dale?
Thank you, Mayor. Thanks, Mark. Yeah, I agree with wholeheartedly with Councilor Kaplan's statements there. Can you help me square a couple numbers I'm trying to figure out? I'm looking at two different charts, financial statements on page 8 of 27 of the draft. Under Table 1, it's financial statements without rate adjustments. And it's just basically an income statement there, and it has the projected 2026 through 2030. You can
See if I can pull it up.
absolutely wait for you if
You
you'd
said
like.
it was page 8?
Yes, sir.
It'd be this one, or?
Draft report version 1.2. It's close to that one. It's just going to be table 1 in the electric
Oh.
draft report, so it might be up just a little bit there.
Okay. There we go.
There you go. Okay.
Yeah.
Would it be possible if you maybe zoom in on that a little bit, just so you can just see it?
Can do.
And
Is there any
down at-
specific-
Down at the very bottom there, before it goes into the next section of projected cash flow.
Okay,
Keep going down just a tad. There you go, right there. So you've got adjusted operating income starting in 2026 of negative 813, then negative 128, and then positive 297, 638, and 826 going across there. Why are those different numbers from the adjusted operating income with no rate changes in the table that you were just showing? And what am I
those
looking at
are-
differently?
Mike, I might need some help with that one.
I'm looking at it. I can see the
Even if we
question.
drop the table in with the rate adjustments.
Yeah, I think it might
think-
be.
I think that's
Let
what
me-
happened.
Yeah, that is.
Yeah,
Was it
this is-
3.9? Let me just check if I put 3.9s in.
Yeah, I think that's what that is showing.
It is, yeah. It's got the rate adjustments in.
Yeah, we'll have to change that table. That was a great catch, thank you. I can, actually go to the modeling, hold on, and show you. This is the financials without any rate adjustments. So the operating income here is 1.4 million negative. Sorry, 1.1 million negative right here.
Okay, so it's just to be clear, that was, okay, I understand now. So what you're saying then, to go back then, is with a rate adjustment of the 3.8, we would then have an adjusted operating income of negative 812 in 2026, because that chart does still bake in the expenses and the capital and the depreciation and so forth of what we would be doing, correct? Because it still bakes in what we need to do relative to capital improvements and so forth. Okay.
Yeah.
Just mislabeled. Okay, not a problem. Thank you for that clarification.
Since I have this up, and I know there's been talk about what would happen in the future, but let's do this once. I know I'm taking more time than probably you want to allot me, but let's say that we wait until year 3. This year, we're falling slightly below our minimums. Well, let's say we wait until year 3 to do rate adjustments. We'd have to have 9% adjustments 3 years in a row, of which 2 years would be below our minimums, in order to get us back. Just kind of give you an idea. Right now, we're looking at, 3.9 each year, and like I said, relatively modest. We're talking about a $3 increase in average residential ratepayers bill. Is there any other questions on this slide?
I just have one, and that is that you had mentioned your earlier comment about that Councilor Dale had a question about in terms of, burning through cash, and you said it was for a projection. So we would be looking at this adjusted operating income. Is that what you meant when you were indicating that? It's not that we have been having that issue, but it is projected forward that we would be burning through cash. Okay,
That is
great.
correct. Yep.
Thank you. Yeah, Councilor Dale?
And yeah, and to add on to what the mayor said, and the reason we would be doing that would be because of significant and needed capital outlay in order to upgrade our systems, because we're at 58% and we need to be in that 50 to 55. Would that be correct, Tom?
Along with the increased BPA costs and
Absolutely.
personnel costs.
100%.
We
Yes,
baked
you're-
in the contract increases and all that.
Yep,
into the-
you're correct on both of those. I would agree. Okay, well, then that certainly makes sense. So, Mayor, thank you for clarifying that. So then, if I may, just one other question.
Yes.
Yeah, so then this is, you had talked to Mark about recommended cash reserves, and maybe I just want to square this so people understand what we're looking at. We're probably using two different terms for the same thing. So, Bryn, we were chatting about this earlier, is our financial policy, much like the general fund for the electric fund, is that we look at the average of actual expenses of the last 3 years. And of course, as we were looking at that, just to get a little bit in the weeds for 10 seconds, as you had explained to me earlier, I appreciate it, that in our financial and our monthlies is actually the budgeted rate. It's not the actual, because we would not have had that actual when we did this in the budget. But it's pretty darn close, as we discussed. And that's about the 4.6 million or so. We see that. So that's the 25% of that. So that's where that number comes from. So Mark, when you're talking about recommended cash reserves, is that the same, we'll say by definition, is what Bryn would talk about is ideal financial policy relative to have that? So I want to make sure, and the reason I'm digging into this a little bit, and I want to get very clear on the words, is because, this council had a pretty in-depth discussion a week or so ago about actual reserves and how actual reserves are different from, let's call cash reserves and an ending fund balance and so forth. So if when you say cash reserves, you're just talking, what we would think about would be a financial policy of that just buffer within, outside of, we'll say, emergency reserves, okay? Then I just want to make sure we're talking about the same number. When you say recommended cash reserves, Mark, do you mean what our financial policy is of that 25% of the last three actuals? Is that your recommended cash reserves amount, or what do you use to
no.
calculate that? And
Yeah,
do we
I
need
have
to
it
look
up
at our
on this.
policies?
Yeah, I have it up on the screen. And you remember, this is minimum cash that we're looking at here, but this is how we determine it. And we look at what your projected operation and maintenance costs are, less depreciation expense. And if you see that 12.3% right here, what we're looking at is a 45-day working capital lag. And if you took 45 days, divided it by 365 days in a year, you'd come up with the 12.3. So that means that we need 1.2 million just to fund that 45-day working capital lag. Then we have purchase power cost. And what we want to happen there is we want to make sure that your largest power supply bill that occurs throughout the year, that's projected, that we have that in our reserves at all times. That's about $870,000.
Perfect. Yep, that makes sense.
Yeah,
Thank you.
Yeah, I'm going to talk about the other two because I think it's important. I'm going to skip over that one for a moment and cover this one. This is we look at your 5-year capital improvement program and we add it up, subtract any bond proceeds that are anticipated, and we divide it by 5. And that's 838,000 a year. The reason we levelize it like that, 2 reasons. One is optical. If we looked at your annual capital improvement program, yours is already
Mark,
levelized.
you're off by a line, Mark. It's the one above. That's the 90 days cash you're on.
What's that?
You're off by a line.
Oh, I
The
see,
one
the
above.
90 days
Yeah.
cash. Oh, I got you. That's the million, yeah. And so we take your 5-year capital improvement program, divide it by 5, and say we want to keep $1 million in our reserves at all time to fund our capital improvement program. So at the start of a construction season, we have the cash in our reserves to fund it for that season. Then we have historical rate base. And remember I said that you were 58%, 59% depreciated? Well, there's unexpected things that happen. I mean, you could have a transformer failure, you could have a ice storm, a windstorm if you're in Florida, a hurricane. So these unexpected events occur. And what we want to make sure happens is that you have enough cash in reserves to start the repair and replacement process until financing can be arranged. So we're recognizing those unexpected events and we're adding about 590,000 for those unexpected events. Now, in your case, you see this 837,000. Normally when we add all this together, it comes up to about 110 to 120 days cash on hand compared to your operation maintenance cost. But because you have more stability and it's driven because of BPA, your purchase power cost at 10.1 is usually that number's around 15% for most utilities. But we want to make sure that even going through this calculation that we recommend at least 90 days, because if you went to issue debt and you were below 90 days cash reserve, you will get dinged on your ratings. So we do want to maintain that, or want to make sure that this calculation comes out at a minimum of 90 days. So that's how this came up. That's probably why it came out so close to yours. Usually it doesn't. Usually our methodology is different. So, but in your case, it came out because it's 3 months basically of cash we want to keep in reserves.
It'll be that or higher. Yeah. Okay, go ahead.
Okay, I'm going to go through these because you guys sound like you're a lot more familiar with utility finance, and I'm going to go through some of these others in between slides real quickly. I put this in the debt coverage ratio calculation because if in the future you do issue debt, this is going to be a critical coverage or calculation that you'd make. You can see our minimum coverage here is 1.4 that we have. The other thing that this shows, though, is this is your cash from operations in 2026 is projected at a negative 500,000. That's before your capital. In 2027, you see this is just through operations that you're running at negative cash flows. And of course, we need this cash to pay bills in a timely fashion. If bad things happen, one of the things that concerns me a little bit going forward in the future, it's both good and bad, is that BPA is you're going to be part of a market, which is the S&P market. And when you become part of a market, there's benefits, but there's also some risk involved in that. because market prices can go up and down, and if you have periods of time where you're short of BPA capacity or production and you have to buy from the market, most likely other people are going to be short also, and that's going to drive the market price higher. And so you're going to have more variability moving forward in your power supply costs. And this minimum cash reserve is going to become more and more important for you. So, you know, a lot of times you when it comes to cash, the reason we need to maintain cash is for rate stability for our customers. Because if something unexpected happens, we can draw down on those reserves without having to have an immediate rate increase. It also allows us to phase in larger rate adjustments. And that's kind of what we're proposing, is that phase in. Right? So,
We have one question. Councillor Duquesne?
Thank you. Great questions. Thank you, everyone. Thomas, I have a question for you really quick. When BPA was here, and they did a great presentation also, I believe they said that we could stay at the tier that we are, that our load had not increased and we didn't have to go to tier 2. Is that correct?
That is correct. And as far as to the market question, well, I'm sure it's sitting there for somebody to ask. Part of the provider of choice contracts does call out market participation, and although the governing structure still needs to be built out in the market, one of the things that's in the provider of choice contract is to preserve that at-cost power for public power utilities that subscribe to BPA.
Thank you. That was part 2. Thank you, Thomas.
yeah.
Great, thank you.
So if anything changes for you guys, it's going to be way into the future, which is really good.
Go ahead.
All right. Now, remember I mentioned the upper boundary that we look at, and that's that optimal operating income. And what that represents in developing that is when you have an asset that you put in service. Let's say you spend $1 million on an asset, and it's a 20-year life. So every year you expense $50,000 of that asset. And let's say you recover that $50,000 through your rates. So at the end of the 20 years, you've recovered $1 million to replace that asset. But every year the replacement cost of that asset goes up. And so what the rate of return identifies is how much the replacement cost of your infrastructure is going up each year. So that in theory, when you go to replace the asset, that you have the cash in reserves, or you've recovered that cash to replace that asset. So it's a theoretical number, but it is based upon something that's solid in a sense, because it does reflect the fact that when customers use your assets, that when you go to replace it, it's going to cost you more, and they should pay for the full replacement cost of that asset that they're consuming. And that's what that represents, and that becomes our upper boundary that we don't want to exceed. Now, in your situation, because the inflation rates over the last few years on electric infrastructure has risen substantially. I mean, 3 years ago, I think transformer costs alone increased like 45% in 1 year. So when we've been doing these calculations lately, they've been coming out higher. But the rate of return, that upper boundary that we're calculating, is about a 12% rate of return. Historically, that number's normally, we calculate out to be about 7%. 6 to 7%, but because the inflation's been so much greater the last few years, that's why we're seeing the 12%. That's not influencing any of our recommendations, other than we don't want to exceed the numbers that's being produced. So, and that means we don't want you to exceed about $1 million a year in operating income. Is there any questions on that?
Nope.
Right. So this is what we proposed, is a series of 3.5% rate adjustments. And by doing that, what happens is your cash reserves stay consistently above the minimum. Your operating income, although it's negative in 26 and 27, we don't like to see negatives, but it's not critical if it does fall negative. We prefer to see it at least positive, and in 2028 it does go positive. And the increase of the 3.9% is a relatively modest adjustment. Ratepayers, it's like $3 a month. So, is there any questions on this rate track? Because this, in many ways, is one of the most critical pieces of what I'm looking for your input on.
Counselor Dale?
I guess I'll, excuse me, I'll just ask a question with a question. I'm sorry, like, Mark, what do you, with respect to, I guess, what factor are you looking for our input on? I mean, I can look at the numbers, I guess, and I would see, and they make sense to me relative to operating and transmission costs and capital outlay and so forth. So based on what I've seen, I understand it makes sense. So I guess at this point, looking at you as a consultant, what should I be thinking about relative to this, if not 3.9?
Actually, that is exactly the input I was looking for, what you just said. That does the 3.9% make sense? And in what you said, it sounds like, in your opinion, it does what we're showing. That the 3.9% does, remember, we're trying to balance the financial stability of the utility with the rate impacts on customers. And in my opinion, the 3.9% does it perfectly, but I just wanted to make sure that you guys are on board with us because on that adjustment, because our next step is to design rates to achieve the 3.9.
Yeah, so just to follow up on that, so just maybe to close the loop in my own mind and the way I'm thinking through this, Mark, is looking at that recommended minimum cash, and we talked about that. I probably over-explained it, just explain it to myself out loud for everybody's enjoyment. But that column on the right fits very nicely and tracks historically with what, and is right in line, Bryn, Tom, I think is right in line with just almost perfect target electric fund financial policy relative to that. Okay. And then just to add a little bit of what I think is we'll call it a bonus here, is you're looking at those projected cash balances, and you're looking at roughly, anywhere between, just we'll call it 1 million above that. So the bare minimum is at 25%. We've got $1 million above that. One thing that I think also people question quite a bit, and where does it live, is our contingency. And our contingency budgeted is about 570, 600K per year. So you could almost think of that, even though it's budgeted, but it doesn't really show up as an actual sometimes when we don't use it or don't need it. But would it be fair to say that we'll call it $1 million there is just a nice gap, of which about 3/5 of that might actually be considered a contingency, if not for anything else, or at least gives us some confidence of anything that goes sideways or so forth, because this money stays in this fund. That $1 million doesn't go anywhere. Okay, just want to be clear.
Stays
Thank
in
you.
the fund. Yeah.
Counselor Kaplan?
Yeah, thanks. I agree with everything that Councilor Dale was saying. The way I think about the contingency is that it's actually it's in the expenses. It's a projected expense, so it's part of the operating income, and so it's in there. If we don't use it, then obviously we have an actual that's a income that's a little bit higher. It's similar to something else that I'm quite interested in, which is our low income discounts, rate discounts. We have a policy of for twice the federal poverty line, we offer a discount of 30%, up to a cap of $400 per year. We've budgeted that at about $265,000 a year in the electric fund. There's also some budget in the water and the wastewater funds. I've been tracking a little bit how much we've spent of that. We're only getting into the heating season, so we're in pretty good shape with that. But when I look at we've talked about our very, very low rates, and we do have very low rates. We're about 23% below our neighbors' power rates for 1,000 kilowatt hour a month consumption per household, which is, I guess, a little bit higher than you're talking about as an average, Mark. But I think of 1,000 is a better number. Nevertheless, we want to make sure that our lowest income households are protected. So we want to make sure that we're adequately financing our low income discounts. I look at Pacific Power, and they actually charge every single account on top of what's shown in the Public Utilities Commission, $3.33 per household, per account, per month. When I tried to spin that out in our world, we have about 12,500 accounts, $265,000. Our implicit charge is about $1.65 per household per month. That's baked into this adjusted operating income as an expense, as an expected expense. If we use it, we realize it. If we don't use it, the income is higher. I want to make sure that we've got enough buffer so that if we need to increase that we can do so. So my question, it's a long wind up to that question. My question is, if we go with these kinds of adjustments, even without increasing the funding mechanism for the discounts, like Pacific Power actually has it right on the bill, we still have the flexibility to be able to increase that?
In my opinion, to a degree, yes. One of the things, I want to caution, I didn't say it earlier, is that historically, when we look at our modeling, our financial modeling, and we look out 1, 2, or even 3 years, our models typically come out fairly close. The actuals come out close to what we projected. But when you start looking out in years 4 and 5, there's only one thing I'm certain of, and that is I'm going to be wrong, because it's built on assumptions. And I think that you guys have historically done a good job of bringing either us back or somebody back to look at these financials, every 3 years or so, just to make sure you're still on track. So if something like that does change, that we're able to pick it up and tweak the rate adjustments. So I know I didn't give you a solid answer.
Yeah.
It would depend on how much. If it was you added 100 or 1,000 to it, yeah, that's not going to be a problem. But one of the things that I do want to clarify is that our modeling does not use your budgets. So like in your budgeting, you have a contingency set aside for that. Our modeling takes the actuals. So if you may have budgeted 240,000, but if you only spent 100,000, we're only going to be using that 100,000. So I want to clarify that also.
Go ahead.
I'd add to that, on the flip of that, what we have seen more often in the past is we've went over budget in that line, and it was offset by something else, someplace else where we underspent. But typically, we have a tendency to go over budget on that line item.
Thanks, Tom.
Okay, go ahead.
All right. I'm going to jump to the cost of service results. And what we're looking at with this slide is we identify your total revenue requirements and we identify who's causing certain costs. In other words, how much is residential contributing or to your, not contributing, but how much is needed to serve them with power supply or with distribution cost. And we develop the allocation factors to identify how much it costs to provide service compared to the projected revenues. Now, I want to caution you about one thing in looking at this. You see this number on the bottom, the 12.6%? We're only recommending a 3.9. That 12.6, what that is the ideal adjustment to hit the optimal operating income target. All right, so when I look at like residential being at 13.2 compared to the average of 12.6, that means that the residentials will get right at pretty much the average adjustment of 3.9. When we look at all of these results, there isn't a utility in the country that charges 100% cost of service based rates. It's virtually impossible. And so we usually try to look at a bandwidth of like a plus or minus 10%. So what that would mean is we look for anybody with less than a 2.6% adjustment, which might be this one, or anybody that's over 22.6%, which might be this one. And those are small classes. All of your major rate classes pretty much fall right in line with cost of service. And what that means is when we do a rate design, we try to move customers slowly toward cost of service. So, but there isn't anything, most everybody's going to see right around that average. Some may see upwards of 4.5%. Others may only see 3% or 2%, but most of them are going to fall within a relatively tight range. Which leads me to my next question. If we do have a 3.9% adjustment, we then ask the governing body how much leeway around that would you allow us to move the classes closer to cost of service. Normally with a 3.9% adjustment, we'll ask for like a plus or minus 1 or 2%. Let's say we do a 1% bandwidth. What that means is no customer class would see an increase greater than 4.9%. And the smallest increase we'd give is 2.9%. And we work within that range. And to me, I think that's an adequate range for what we're looking at here because you're so close to cost of service. So is there any questions on the cost of service results?
No.
I'm going to just talk briefly about the customer charge, and I'm going to show you what the results showed on that. The customer charge is probably one of the most least understood charges a utility has. A lot of times customers think about it from the standpoint that Dunkin' Donuts doesn't charge us to walk through the door. Why does a utility, electric, water, wastewater utility, have to charge us a fixed fee every month? And the difference between Dunkin' Donuts and a utility is that a Dunkin' Donuts makes an investment on behalf of the community, all right? But a utility makes an investment specifically for every customer. So when a customer gets service, they have a meter that's installed. The utility has the responsibility to maintain that meter, to replace that meter. They have to read the meter every month. They have to send the customer a bill. They have the cost to maintain the service drop. Those are fixed costs that do not vary based on consumption. And I'm from Michigan, and I think Michigan's a great state to live in during the summer months. It can be kind of tough sometimes in the winter. And so we probably have 15 to 20% of our population that goes south. And if we don't charge the proper customer charge, that means that our year-round ratepayers, the ones that have to endure our winters, are subsidizing seasonal customers. So there's a fairness issue when it comes to charging the customer charge. Now, with that said, when we looked at the results compared to what you're currently charging on a fixed charge, you're relatively close. So there isn't a dramatic difference. There's some tweaking that needs to be done, which I'll cover in the next slide, but you're relatively close. But I really wanted you to understand what a customer charge is and why it's important. But one of the things that is also oftentimes misunderstood when it comes to electric, not water, because water, what I'm going to say is not applicable to water, is that low income is not necessarily low use. And we've done a lot of analysis on that, looking at low income customers and their usage. And what we've identified is that, let's say hypothetically, your average residential customer uses 700 kilowatt hours. Your low income probably uses on average a little less than that, maybe 650 or 675. However, what you see when you graph it out is that about 2/3 of your low income use less than the average residential, but 1/3 uses more, some of them substantially more. And that could be because they're living in homes that don't have the proper insulation because they're older. They don't purchase energy efficient appliances, so their consumption's greater. So there's various reasons that cause some of them to have higher than average usage. So in setting the customer charge, it's not necessarily a low income issue. There's other ways of dealing with that, and I'll get to that also, which you already have in your rate structure. Water's another story, and I know we're not discussing water here, but water, low-income customers actually use a lot less water. So, but in electric, that's not the case.
So I just want to
So-
do a time check. We have 17 minutes left in our regularly scheduled study session. So just
Okay.
wanted to orient all of us to that timing.
Okay, I'm sorry, I can talk for a long time, I apologize. But I just want to point two numbers out here. Your current residential customer charge is $16.25. The cost of service study says should be up around $17, so you're really close. Now, what we're looking at is the planned 3.9% adjustment with a bandwidth of a plus or minus 1%. And that means the biggest increase any class will see is 4.9, and the minimum would be 2.9. And we want to move each of the components a little bit toward cost of service, so that fixed residential customer charge, we're proposing like a 50-cent increase. And we did design the rates for the residential, and we're looking at like a 3.8% adjustment. One of the things that you have in place right now is an inclining block rate, and there's cost justification for this, where the rates get more expensive with increased usage. And we're hoping to continue to keep that inclining block rate and adjust the components, keeping about a 20% differential between block 1 and block 2. And with that 3.8% adjustment, this graph shows the percent impact on customers at different levels of usage. Okay, and you can see almost everybody's going to see pretty much right at the average increase percentage-wise. From a dollar impact, it's going to be about the average usage in Ashland is about, I think it's $6.75. But we're showing the average at around $7.50. So it's about $3 a month is the impact or increase. And of course, I'm not looking for any approval, obviously we can't, but what I am looking for is what we proposed, do you have any issues with what you're seeing? Does this strategy look acceptable to you? This is my last slide, by the way.
Can you go back one? Because I think this one slide back is actually the items that we would be giving recommendations around, or if we had any concerns. That's correct?
That's correct, yes.
These are the elements. Okay, so what I'd like to do is just open up the conversation among the council members about these items that are in front of us that are highlighted, and anybody want to take on a particular topic of conversation there? Councilor Duquesne? Oh, I thought you were motioning me.
No, I was thinking. No, I was looking at, and something that was mentioned earlier, maximum 4.9%, minimum increase of 2.9%, and in front of us is 3.9%. And this is going to come back to us, and I don't have necessarily any questions for Mark, and I'm sure I will have some thoughts when this comes back to us, but what would it look like at 2.9%? Mark had mentioned a plus or a minus.
Yeah. Let me go back to the modeling if I can. Might as well show it to you right on screen.
Yeah, you mentioned a minus one or a plus one.
Well,
If
oh, go ahead.
If we did 2.9% each year, you see that in 2028, we start falling below the minimum because we're still in a cash burn situation. So if we did 2.9, we would have to go up to something higher.
And if I understand correctly, that one, because I think that there's some confusion around that 2.9, 3.9, 4.9 piece. Do I understand it correctly that the 3.9 is kind of the average, and that some of the rates would maybe change a little bit more than that, some might change a little bit less because you're aiming towards aligning those with the cost of service? So if this council were to say, yes, come forward with the recommended rate change as a resolution, then what would come forward is a set of changes that would move between 2.9 and 4.9, depending on that line item and what the cost of service is. Is that correct?
It would depend on the customer class.
And the customer class, yes. So we're trying to not only lift the whole system in terms of a certain amount of more income to the system, but also trying to refine some of the costs for specific closer
It's moving each customer class closer to the cost of service number.
Right.
And so that's why there's the bandwidth there, because some classes are already closer than others.
Great. Did you have any follow-up questions, Counselor?
No, I was looking at the customer
Oh,
class service.
your microphone's not on.
No, I was looking at another slide, Table 9, under the summary of the customer class. It makes sense. Thank you.
Any other discussion? So if we can go back to the slide that has the recommendations, what the council is being asked for this evening is to direct staff to come back with a rate resolution at a business meeting to adopt the recommended rates. And this would be the elements that they would build that resolution off of. So we need to know if there is support for council or for staff bringing that resolution forward. We just go around. Councilor Sherrill?
Yes, Mayor. I would support looking at a resolution to come up with something similar to this. Is it still appropriate time to ask questions?
Yes, it is.
Okay, I just, obviously, Mark, you put a lot of time into this, probably with help from a lot of people. And my question really is to Tom, like, you're the person that probably lays in bed at night and wonders when X, Y, and Z is going to break. You know what your payroll looks like. Mark asked us if we would accept a rate increase like this and moving it forward to the people of our town who are already cost burdened, you know. Is this acceptable to you? Is this what you think you need Is it too much? Is it too little? What would you ask for?
Well, I'm fortunate to be able to work with consultants like Mark and Mike and the whole team at UFS. But if they are showing where we can stay in the green, so if we need to debt finance stuff so we can push that future rate increases out to the customers that are actually going to benefit from it, that is a key to me in maintaining this financial health. So yeah, it's something I'm comfortable with, and I think it's imperative that we kind of pay attention to those numbers and move in a rate track like this to stay financially healthy, so that we can do those bigger projects that we know we need to. We saw it all. We went through it in depth with the 10-year planning study, the master plan. So we know we've got those things on the horizon, and being able to healthily debt finance those things will be key to not having huge rate impacts in the near future.
Thanks, Tom. Yeah, thank you, Mayor.
Councillor Dale?
Thank you, Mayor. Yeah, just a couple of comments. So, Mark, you lost me at the donut analogy, probably a good thing. But I would summarize just because I need to say it, I would summarize the customer charge in one sentence, which is that $17.05 is the opportunity cost to be able to have instantaneous access to electricity anytime you want it, anywhere, again, at any time, because there's transmission lines in the ground, there's everything, all of the stuff. It's you're fighting basically entropy, not to get geeky about it, but it's constantly breaking down. And to be able to just have that opportunity for $17 to flip a switch at any time that's what you're paying for in one sentence. And I want to also just continue and appreciate Councilor Kaplan bringing up the low income aspect of this, and so the short answer is yes, I do support this, specifically for the capital outlay for the transmission costs, what we're trying to do. But because there is a little bit of room, I think I would hope this council would take up at a reasonably near date at some point, just maybe as we get in mid-budget, to look at this and see what this looks like as we put this in, to see what we can do for maximum effect for our low-income households. So yes, thank you.
And you were approving of?
I am.
Yes. Councillor Bloom?
Yeah. Ideal? No. Acceptable? It's going to be a word I'm going to be thinking about all night. Yeah. For me, I think we have a habit in this country of burdening future generations. And this is about doing what we need to do, what our responsibility is, to make sure that we're not doing that. And so, am I stoked about 3.9%? No. I know that it's been thrown around that it's, $3 on average, that's acceptable. Depends on who you ask. That can be a lot of money. But I'd rather be paying $3 extra a month now than 10 plus extra dollars a month in a few years, because we decided we didn't want to make the hard decision to keep this afloat. So, yeah, I support this.
Councillor Kaplan?
Yeah, thank you, Mayor. And I support everything that the three councilors before me said. And the one additional thing that I guess I would reflect on is that a 3.9% increase this year still has us with a net negative for a couple of years until we actually stabilize and go above that line. So I think that's a nice balance to strike. I think it's doable. I think we can manage that rather than trying to be more aggressive and have a higher increase in order to hit that those numbers right out of the gate in year one. So I'm supportive of it as well.
Councillor Duquesne?
Thank you. I appreciate what everybody's brought to the table. And something that was mentioned, $3. $3 is not a lot, but compounded onto what's already put in place for our ratepayers. At this time, I understand the numbers, the need, but to ask a question, I do believe that to our city manager, that it was mentioned that if this is to pass, this utility hike, it would go towards paying the salary that was just put in place for our staff. Is that correct?
So all the revenue that the electric utility generates goes towards the electric utility. So in part, it would pay for the linemen and the electric staff.
Because I do recall, if I'm right, that sometime in August, it was mentioned that having the utility, this electric rate go up, it would go towards the raise that our staff just recently received.
So I think you're recalling some of the numbers that ensuring that we keep rates at a rate that ensures we can employ the appropriate staff was part of that council communication back in August when the IBW contract came through.
I will have to. I appreciate your input. At this time, I can't support this. I know that the hard work that Mark and Mike have done, that this is going to come back in front of council. But when it does, I can't support the timing on this, so no.
Councillor Hanson.
Thank you, Mayor. And it's been a great discussion to mostly listen to. Really brilliant details in those numbers, and there's a story behind every single one, and I'm glad we fleshed out so many of them. Yes, I'm in support of maintaining sustainable electrical rates relative to our infrastructure. I mean, look at our neighbors around us. They're a for-profit, our competitor, if you will, our electrical competitor. They're a for-profit organization that's dealing with, massive lawsuits and losses and infrastructure that's failing. And they're a for-profit organization that's been doing things differently than we have. We're extremely lucky. We have so much uptime in the city of Ashland, but like everything else, things get old and they break. And this 59% aged number is interesting. We need to not kick the can and moderately raise rates so we don't have a major catastrophe that literally breaks the bank, which would drastically impact our city and our ratepayers and our uptime. Our business community really benefits from our uptime. Our neighbors have lots of power outages that we don't have. So it's unfortunate, as all things that inflate, but also it's necessary. So yeah, I totally support a modest rate increase. This 3.9% will work. If it's a little lower, great. But we're doing all the right things, I think, here with this plan, and I appreciate that we're going to take responsibility and not just leave it to another council to do the hard duty and maintain this fiscal responsibility. And also, thank you, Tom, Mark, and Mike. It's very in-depth, and I appreciate all of this. We're also looking forward to this future strategic plan so we can see what it would be like, among other things, to produce more of our own electricity to be able to lower rates and have a better low-income strategy. I mean, maybe someday our federal grants will come back and we'll be able to install a couple megawatts with grant funding. Thank you.
Thank you, Councillor. So I think this is one of the hardest things that councils have to do, is to keep up with the cost of service and to make sure that we are investing in infrastructure at the rate in which it's needed. And we see what happens in other communities when they don't do that and they get so far behind that the catch up is almost impossible to do. And they certainly can't do it without a massive shock to the people who are reliant on those services and the businesses that are reliant on those services. So while I am never happy to see a rate increase come, I appreciate the thoughtfulness, the deep analysis that we've been looking at here, and also the willingness to move to that middle space. So we don't have in front of us a rate change that would immediately move us or would even move us to that optimal operating income space. It's a middle ground proposal that keeps us in a healthy place, but isn't maxing out and pushing us right up against the boundaries of what would be maybe the perfect operating system. And so I appreciate that. I've heard, as we've gone around, some indications around our low-income program. Am I understanding correctly that in addition to these next steps, we would also want to make sure that we're protecting our low income, our ability to assist low income people in this when the rates come back. Do we want to have that discussion? Councillor Bloom?
Yes, maybe somebody can jog my memory, but my understanding is when we had that conversation that we were going to look at everything mid-biennium and see where we were tracking. And so, yes, absolutely. I'm just wondering, are we doubling up on a conversation that is already coming probably in the next 6 months or so?
So maybe Mark or Tom can clarify this. So I would assume that that program is taken into account with these projections. And if, as we track, if we see, a significant deviation from what we have budgeted, we would need to take that into consideration and kind of reevaluate future rate increases pending what the council may decide to do. But our intent is to bring that back to see if what we budget currently makes sense or if we need to adjust it.
When would be the best time to kind of actually have a trend line, to actually kind of understand if we're on target or not?
We really would need the full year because, this is a different program and we've seen, it's all encompassing $400. We've seen water. Unfortunately, we've seen folks use a lot of water in July and August that have reached their $400 max already. So I think it's important to see the full year, and because we have a biennial budget, we do have that luxury to see the full year.
Okay.
Councillor Kaplan?
Well, and also just appreciation to Bryn for now reporting this on the quarterly financials. You did the first time last quarter, so I'm looking forward to so we have more or less, it's not quite real time, but it's closer to real time rather than having to wait for a full year to do a reassessment, which is, I think, appropriate. But we'll be able to track it quarter to quarter.
Correct.
Thanks.
Okay. So the council's direction to staff this evening is to bring a rate resolution forward at a business meeting to adopt the recommended rates in accordance with the presentation that we have seen this evening. And so thank you, Mark and Mike, and also Tom and Bryn for this in-depth conversation. I hope the folks at home are also tracking and digging into the numbers so that we can understand as a community what is in front of us. Thank you so much. Have a good evening. Happy holidays, safe travels, and we'll see everyone in January. Meeting is adjourned.
Thank you.